We're back with another Straight Talk. Today, we're going to talk about rising yields and do they really affect the markets? Obviously, a lot of people are freaking out right now. Okay, deep breath. We're going to talk about it. We're going to go back in history and we're going to show the facts. Let's go. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. First time here. We do a lot of videos like this, straight talks, educational videos, market updates twice a month, latest up here. If you like what you see, please do hit that subscribe and like. So lots of talk about rising bond yields. And in fact, the market went sideways for 5-6 weeks because of rising yields and the market trying to digest it. Now, first off, if you've been here before, I talk about the cycles, all right? We're in cycle 2 right now. That means we're in growth mode. Have a link up here to a video on what that means and what to look for. Well, the one thing you look for is rising bond yields, okay? That's why we got out of treasuries as we went into this cycle, okay? So let's go and take a look at the facts. Now, the first thing is we have a process, very detailed, not going to get into it, but look, observe, orient, decide, act. It comes from a great book, John Boyd. Have a link below, okay? And that's what we have to do here. You have to see what's really going on. All right, so the first thing is your 10-year treasury. Now, obviously, you can see the bottom, and then we've gone straight up. So, sure, we've got rising bond yields, no doubt about it, okay? But here, let's take a look at what's called the yield curve. This is your 10-year treasury minus your 2-year treasury, okay? Couple things. As the yield curve was going down, okay, let me clean that up a little bit, get rid of some of this. As the yield curve was going down, that generally means that we're in anticipation of a recession. Now, the Fed stepped in and some other things. We did have a short recession, but same applies when we're going the other directions. Now, you can see here a high, higher high, and then straight up. Higher highs is a good thing. That's bullish. Now, when they go up in yields, keep in mind you lose money. Yields go up, bond prices go down. Okay, so right here, sorry about that, I did all kinds of things. It's showing us that obviously the yield curve's going up and the market's going up. So let's take a big view here over the long term. Now, understand we are coming off the best bull market in bonds in history. Go back to the 80s, right? 18, 19%. All the way down to 1.5%. So in that case, yields go down, prices go up. We've made money in bonds for a long time. Now, we've had little hiccups where we've gone down, up, right? These counter trend moves is what they're called. So let's take a look at a couple of those now. First one's 93, 96. Okay, want to show different variations, right? You bottom out here. Keep in mind, you're bottoming out in 6.5%. Think about where we are today, okay? And then we go to the top here. We're going up. Not much movement, right? And then it seemed like in this time, the market obviously liked when rates were going down. So understanding past performance does not guarantee future results. So let's take a look at 13. When you take a look at 13, right, a little more obvious here in what you're seeing. So you're going to bottom out, okay? When you bottom out down here, obviously went higher and then higher again. You know, and here we're in the 3.5 range. But look, here's your S&P, and it has continued to go up during that time. Why? Well, because we're growing at that time, right? Think about it. Since the crash of 08-09, we've gone not straight up, but we have, in fact, gone up. So let's look at 2016. This one looks real clean. Let me clean that up first. Speaking about clean, come on now. All right, so what do we have here? There's your bottom. Okay, let's stop right there. Let's correlate to that spot. Then we went up. Market goes up. Kind of came down again, but guess what? Market didn't react. Kept going up, and here we top out at about 2.90, 2.9%. I mean, think about that. People are worried today about rising rates, getting not even to 2% yet, and we're at 2.90. So here in 2016, there was no effect, okay? So let's take a look at the current situation. And as you would expect, okay, we bottomed out, okay? This is last year in, say, July, August. All right, about 153 was your bottom. Started going up, right? Started going up, 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 up. Oh, wait. And there's the market, okay? Why? It has to do with the cycles. Again, you have to anticipate this. This is not a bad thing, okay? We understood this as we utilize our cycles. That's why we are not always in treasuries, right? This is not a good time to be in treasuries again because yields go down, okay? Excuse me, yields go up, prices go down, okay? So you have to be careful with that. And the other thing is, again, forget about all the noise in the news out there, what's going on. Focus on what matters. And right now in cycle 2, it's growth, earnings, right? GDP, we're seeing it, earnings. Manufacturing number was good, had a good unemployment number last week, right? Those are the things that are driving the market and driving yields higher. Michael Loftus, Wealth and Wisdom TV.